huge company, Mo. Not huge. You saw zero benefit. They can easily afford this dividend. Wow, that's a big cash flow growth. The thing that's made us so famous. So pretty solid. CVS hit a 52-week low on January 25th, which was just 5 days ago. According to our software, it was at $84.82. All-time high was all the way back in 2015 at $113. So on this channel, if you're new to watching us, we are value investors, but we are true value investors. We don't just say it and buy irrational stocks. We realize that every investment is the present value of all future cash flow. If you watch our channel enough, you will have that ingrained in your head, that statement. Mo, I get so many Instagram and Twitter messages from people saying every investment's the present value of all future cash flow.
Yeah.
And once you realize that, you realize all I'm doing is buying a set of cash flow.
Right. No matter really what you're buying.
No matter what you're buying, even if you're buying something that can only be sold one time, right. It's still negative day one when you buy it because you outlay money, 0, 0, 0 until you sell it, then it's a present value. That's it. Yep. That's all investment is. So do me a favor, subscribe to the channel and enjoy this video. You'll notice that we don't have any YouTube ads in this video, so more on that later. So CVS, huge company, Mo.
Yeah, I mean, they're the top two, I would assume.
If you have our software, pull it up because we like to go through this stuff here.
Them and Walgreens.
What was that?
Them and Walgreens.
Yeah, Walgreens. So, a couple big things on CVS. Look at this, Mo. Market cap of 115. Look at this enterprise value, 258. For those of you who are new, the difference here is basically debt. Now, I will say something. That doesn't worry me so much because
capital leases and stuff.
It's the leases and all those things, and they have primo locations.
And if you just comparing, I mean, when I see outliers like that, I like to compare.
What's Walgreens?
Here, 32 billion enterprise value.
97.
97. There
so
you
it's
go.
three times more.
Yeah.
And here it's 2 times more, a little over 2. Mm-hmm. So from a ratio standpoint,
kind of like this one better.
Now, but wait a second. What's the market? What's the PE of Walgreens?
Good question.
Look at the 5-year PE for Walgreens.
13.6.
This is 22.
Okay.
So a lot different.
Yeah, a lot different.
All right, guys, big dividend here. 2.5% pays out 2.85. Now, we want to make sure they can afford the dividend. If you look up here, their free cash flow last year was $19.5 billion, 5-year average 12.37. They can easily afford this dividend. It only eats up a little over 20% of their 5-year average free cash flow. But look at these margins, Mo. Wait a second. They had $19.5 billion in free cash flow last year on 1% profit margin. Wowzer. 1-year PE of 36, 5-year of 22. It makes sense. Their profit margin is half what it was in the last 5 years, so it makes sense that their PE would be higher. So let's go check out their profit and loss statement. So guys, whenever I see a big difference between a 5-year profit margin and a 1-year profit margin or the PEs, there's got to be something that happened in that year. And look at it right here. Other income and expenses. $9 billion loss right there. $9 billion loss right here. In past years, it was 1.3, 800, 2.2. So there was a huge loss right here. So that adds $9 billion to their profit. Instead of 3.15, they should have $12 billion in profit. Now, go figure out what that is. Was it a write-off? I don't know. It probably was a write-off of some sort. So what was that write-off? That's something you have to figure out through the 10K. All right, let's check out our 8 pillars here. The thing that's made us so famous. All right, a low ROIC. That could be affected by their earnings recently. Lower PE and price. Oh, look at this price to free cash flow, Mo. 9.3. They're spitting off a ton of cash flow.
They are.
Cash flow growth is huge. Revenue growth. Wow, that's a big cash flow growth. For such a low margin business, that's interesting.
It is interesting. A lot of these numbers are
confusing.
And
now shares outstanding, I'm not worried about. They probably made an acquisition with those shares. So 29% shares outstanding. I'm gonna go to the income statement and see if it was a big jump in 1 year, and it was. Look back here, 2018 to 2019, huge jump. They probably made some sort of acquisition that skyrocketed their shares outstanding. Is that good? I don't know. It all depends on the deal. You know, there's a lot of value investors out there who won't even look at a company unless their shares are the same over 10 years or down. And 10 years ago it was 1.22 billion shares. Today it's 1.32. Not a huge number up, but still they're diluting owners. They're splitting up the profit amongst more and more shares as they issue more shares. So as an example, if the profit's up 10%, but the number of shares are up 10%, you saw zero benefit because they have to split all that money up evenly. Think about that again. 10 shares outstanding. If they have 11 now, you're now splitting the profit up by 11 shares versus 10. So even if profit goes from $10 to $11, it's the same per share. So that's how it can hurt you. All right. What else we got here? Analyst estimates. Mo, what are you looking at? You're looking awful strong over there.
I'm looking at the revenue. I'm trying to see if it's sustainable. So the jump in revenue happened in 2018 and 19. And
that was the acquisition.
That was the acquisition. So that's fine. I'm just trying to figure out, like, is this a sustainable...
So Mo, the other thing is, here's the interesting part. Income growth and inflation will drive their revenue, correct?
Yep.
Like when you go to CVS, if you buy, even if you're not there to buy some sort of medical thing, let's say you're buying pop.
Yep.
Are you telling me pop's going to be the same price 30 years from now than it is today?
No, it'll be more.
So the question is, how much more will it be?
And I like that they're sort of spinning into that healthcare area where you can go there and kind of see a primary care.
And I think that'll only get better as time goes on.
I think it's called Health Hub. I think that's what it's called with them.
What's urgent care?
Urgent care? It's like if you haven't emergency.
But isn't there an urgent care? Is that the name of it for something like CVS Urgent Care? Maybe I'm thinking about something else.
I don't know.
So guys, here's the analyst estimates on CVS. Now, there aren't many here. We usually see, I'm actually surprised only 27 for CVS. See, look at Mo's face.
There's only 3 of them in 2027 for a company this big?
For a company this big, I would have expected this number down here. I would have expected 27 down here. But here it is. They're expected to make $9 a share this year and $13.30 in 4 years. It's still double-digit growth per year, so pretty solid. And let's look at their revenue growth. Not huge. For me, for CVS, I'm factoring in 3 or 4% revenue growth for the rest of the time. Maybe a little bit higher.
If they crush it in that other
I just think it's going to be inflation.
Yeah.
Right?
Yeah.
I mean, I don't see how much more it goes without, maybe a little bit better than inflation. So guys, what do you pay for CVS? Now, this is our stock analyzer tool. Before I get into it, as I told you, we have no more YouTube ads on our channel. If you're interested in this software, you can have it for less than a cup of coffee per day. Please check it out. The Everything Money community has already helped thousands of people exactly like you to help them understand financials, understand investing, and understand the emotional side of everything to make better decisions for your future and your money. What you get with the software is my 8-pillar process, our stock analyzer tool, which was used over 1.3 million times in 2022, and all the other stock screeners that the Everything Money community of intelligent investors use to find their value plays. These are the exact tools that Mo and I use every single day to find the investments that make the most sense to us. And you also get access to Mo and I and all the thousands of other Everything Money investors, so you don't have to do this alone, because that is the hardest part about investing, is being on your own. Make the choice I made. Invest in yourself for a little over $1 a day to make these decisions easier and smarter as time goes on. Here's the catch. We're not going to give you fish. I'm here to teach you how to fish. If you're looking for a magic bullet, we're not the site for you. We're not the channel for you. If you're looking to become a smarter investor who can find their own process, welcome home. Get started now, risk-free for 30 days at everythingmoney.com. All right, guys, back to Stock Analyzer tool. So we're trying to figure out a price to pay for CVS today, not including the balance sheet. I'm not factoring the balance sheet at all. That's about the health of the company. I just dropped my pen. So Mo, do you want to do 10 years or 20 years?
I'll do 10, but I think that we're going to probably run into some pretty similar numbers.
You're probably right. And I like doing the 20-year numbers. And the reason I like to look at 20 years is I'm trying to find companies I want to own forever. So I'm really trying to look as far out as I can. And the software allows you to do 1 to 20-year analysis. So our job here is to put in our revenue, low, middle, and high growth assumptions, profit margin, free cash flow margin, PE, and price to free cash flow. Now, keep in mind, a big chunk of this revenue growth was that acquisition. I'm assuming they make no more acquisitions in the next 10 years, in the next 20 years. That's not likely. But I want to look at the company by itself. All right, Mo. So you put your numbers in, I'll put mine in.
Okay.
Dun, 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 dun. Okay. Yeah, this is kind of interesting here.
I will say my high side number is pretty high.
Mine is
revenue
too.
Growth, but it's if they crush it in that kind of healthcare space that they're trying to expand into. So, and I let profit margin roll with that a little bit higher. So we'll see.
All right. So I did some things a little bit different here. So Mo, low, middle, and high, I did 3, 4.5, and 6%. What'd you do?
I did 2, 4, and 6.
Okay. Profit margin, I did 1.752 and 2.25.
I did 1, 2, and 3.
See, I think 1's too low, Mo.
I think 1's too low. 3's high. 3's if they crush it in the space of.
In fact, maybe I should be doing 1.7. You know what? I'm changing this actually. I'm doing 2.25 and 2.75 because if they start to get into more high margin medical stuff, that's going to drive this margin up.
That's exactly it. Yep. Here.
Okay. Free cash flow margin.
4, 5, and 6.
I did 4, 4.5, and 5, but I like your, I'm going to do 4.7, 4, 4.75, and 5.5.
Okay.
PE.
12, 14, and 16.
So I don't blame you for that. I went back and forth on this one. I did 14, 15, 16 because I think the moat they have these great locations. They have a great, but the only thing I don't like is their return on invested capital isn't the best.
Yeah, 7.5.
Yeah, which is bad, but I'm wondering how much that was driven by a low no-pat lately. Either way. Same with price of free cash flow. I did 14, 15, 16.
Same thing.
The IRR, desired return.
12.5, 15, and 17.5.
I did 11, 13, 15.
I think that's very fair.
Because I sat there and said, I already beat this up quite a bit here, I feel. So do I want a little bit of a premium? Sure. So guys, I'm going to hit the analyze button. I already did. 6 numbers are going to pop up. Low, middle, and high on earnings multiple and free cash flow. Mo and I are both going to have numbers, so please stick with this. And don't forget, guys, check out everythingmoney.com and please share this video with some of your friends who might find value in this and just want to think about investing in a different way. Or they've been looking at CVS.
Yeah.
All right, analyze button. Mo, what were your numbers?
25 to 101 on the low end, 83 to 167 on the high end, middle ground of about 55 to 135.
All right, I had a 55 to 125, 68 to 151, and 61 to 140. Now, the big difference is such a big difference between free cash flow and their margin. I would focus, free cash flow is really going to drive this thing. So to me,
75.
Man, is this a good deal, Mo? I can understand somebody buying it at today's price.
I agree. Yep, I agree. And it's on my watch list for 75, and it's been there for some time. I'm just being patient with it.
I don't even have it on my watch list. All right, guys, thanks very much. Again, subscribe to the channel, and please share this video. Take care.